What if I told you your total closing costs are completely up to you in most cases? That's what I'm going to show today. This is Jeremy Levitt with the Happy Home Buyer number 9, and let's get right into it. Really, the scenario I want to talk to you about is, let's pretend you're buying a $300,000 home and you're putting 10% down. Most people know at this point that you're not just going to spend $30,000 total out of pocket. You've heard of the concept of closing costs and prepaid items, but what most people don't know is how much these are going to be. And honestly, I'm not answering that question for you today. It varies on every scenario. It varies based on the house you buy, what day of the year you buy, what area you buy in, all those fun things. I'm going to get you in the ballpark, but more importantly, I'm going to show you how the total figure is actually completely up to you when it's all said and done. So let's jump right into it by showing you some of the simpler pieces. So here we've got prepaid items, and we can really break those down into 4 things: interest, insurance, taxes, and HOA. If you have no concept of what a prepaid item is, it goes like this. Let's say you close on the 25th day of the month, and there's 30 days in that month. You're going to prepay those 5 days, the difference, right at closing. There's no such thing as a free day of interest with a mortgage company, so you prepay that amount. Same thing goes with insurance and taxes. You're going to prepay a certain amount of the insurance and taxes there. Also within the prepaids, we're going to establish your escrow account. This is the account where you pay all of your bills monthly as far as the mortgage payment is concerned, and then we take the taxes and insurance portion of that and we save it to pay those taxes and insurance when they're actually due. These are your prepaid items. These don't really fluctuate much. Your taxes don't fluctuate until the county says so. Your interest is based on what day of the month you close on. And your insurance, you could shop for cheaper insurance or not, but we're not talking a huge fluctuation here. Later, I'll show you where the fluctuation comes from. Second piece of the puzzle is your closing costs. Here, we can really break those down into 3 big pieces: lender fees, appraisal fees, title fees. I'm going to talk about lender fees last because that's where the meat and potatoes is here. But as far as your appraisal fees go, there's only so many appraisers and so many appraisal management companies. Most of those, we're not going to call them fixed, but they're extremely close to each other. It's very rare that I'll see an appraisal for this house cost much more than the house next to it, regardless of the lender or the appraisal management company. They're very, very similarly priced. With title fees, you're going to choose the title company that you're going to use right when you write your contract. Your title company is going to then have its set fees that they publish and that they're going to have for your situation. That's going to be based more on your loan amount and the sales price, things like that. You could shop for a cheaper title insurance company, but again, there's not a huge fluctuation that I see between an extremely expensive title insurance company and a very inexpensive one. There is a difference, but we're not talking a huge difference. Where there is a huge difference, though, is in the total lender fees. Now, each lender is going to have a different type of fee structure, different rates, things like that. But even if you chose one lender, within that one lender, you can have different fees based on the loan program that you have, also based on your particular scenario. So the higher your credit score is, the lower your loan amount, or the lower your interest rate and your fees are going to be. That's what I'm going to illustrate here. So it's important not only to set yourself up by having the highest credit score you can possibly get, things like that, but obviously also to shop for a really inexpensive lender, because in the end, all you have is your rate. But I'm going to show you here how that really translates into a huge fluctuation right at the closing. So this is the same example. We're talking about our $300,000 purchase, putting 10% down. We're going to assume a 760 FICO score, buying a primary residence here in the state of Arizona. So our standard lender fee is $695. You're going to see lenders' fees vary. Their standard lender fee varies from close to 0 up into 1% or more. So 1% here would be $2,700. So you can see we're kind of on the lower end of the standard lender fee piece. But where the big change comes in is what interest rate you choose. With most lenders, you're going to have an option of a range of interest rates. The lower your interest rate, the more expensive it's going to be in reality, because the lower interest rate has a lower yield for the investors and the banks that sell them. It goes into a long explanation. On the reverse side of that, the higher your interest rate, the more the banks and the investors are going to make off of you, so they actually give this larger lender credit. Now, with each interest rate, there's a cost or a credit associated with it in most cases. A cost would be like if you're paying discount points. To buy a rate down, this means you're paying a cost to have that lower rate. Same side over here, I'm showing just lender credits. So let's say, for example, if you chose a rate of 3.625% today, you'd receive a lender credit in this exact example of $338. That just means that the lender made more in yield spread premium than they anticipated, and so they passed that credit on to you. So your total lender fee of $695 would be offset partially by this $338. You, with us today in this scenario, could get 3.625% for that conventional loan and pay a total lender fee of about $350. On the other side of the spectrum, you could also go all the way up to 4.0% and get that massive lender credit of $5,063. After it offsets our entire lender fee, you'd have $4,300 left. That $4,300 could then offset your title fees, your appraisal fees, and all your prepaid items until the credit's just completely used up. This is one way where you can go from paying a standard lender fee basically plus all of your fees to just choosing a different rate and then having most of your closing costs and prepaids paid for by that lender credit. This is how I say, this is really how I'm saying how you get to choose what your total closing costs are going to be. Now, that shows you there that you can have this relatively small fluctuation in rate to help decide which kind of range of closing costs you want. But it should also show you why it's extremely important to, shop me, because at 4.0, I'm still under the national average rate that's being offered. And that national average rate is not coming with a lender credit. It actually, if you read the MBA article from last week, was coming with a origination fee of something greater than zero. Let's put it that way. With us, you would not only have a lender credit, but it would be a $5,000 lender credit. It would offset the $695 origination fee completely and leave you $4,300 to use to pay for other things. And that's just comparing us to a lender that is at the national average. There's, of course, lenders out there that are more expensive than the national average. So that's how you can choose exactly what your total closing costs are going to be by fluctuating your rate and by shopping for just the right lender. And that's how you can continue to stay a happy home buyer. If there's anything I can do for you, just give me a call, 480-744-6040. Watch out for our next episodes. Talk to you soon. Thanks.